Thanks, Amy. Good afternoon, everybody. And it's we'll just while we're here, it's section. This is the first formal meeting of the committee, I think. Is that right? Yes, it certainly is that case around. So look, welcome everybody to it. Congratulations on your appointment to the Board of the Risk Committee. We have a bit of fun along the way, and it'll be good also to note later on that we do have a workshop coming up next month. It might give us just perhaps a more chance that we'll be able to chat about the committee rather than just necessarily doing the business. So we'll look forward to that. But we've got a great little program here. Thank you, Stefan, Dan, Charlie, Amy, team, whoever's put this all together. It's a really good start for us to do our work in terms of role of the risk committee. Welcome to anybody that might be down the back there that's public. It's welcome. It's good to have you here as well. I always enjoy being public at our meetings. Not, can I say, it's common for a risk committee, which is interesting. People know about cell phones, and we're recording the meeting. You folk know better than I do the health and safety for getting out of this room, but it's really obvious. So I've asked people how they are, and they've said they're all busy as. So what a good time to pull on the carrot here, just to centre ourselves and to announce the meeting going again. Hope you join me. Kia ora te manaina, kia whakapapa no te moana. E urahi ma tatua I te ranginani. Aroa tatu, aroa mai. Tatua I tatua katoa. Kuia takia. Brilliant. That's great. We have apologies. I wonder, I don't think Martin, you know, in this. I think we should just sustain one for Martin. He did mail in that he had COVID. Let's just sustain one for Martin. He may come on. This is Collier. Collier is here, I think. Yes. If I saw that one, Collier was here. And I think otherwise, as far as I know, that's the it's not an apology, but welcome for being here as well, Rachel. It's great to have you here too. And as I indicated to you before, I invited Rachel to participate in the meeting. I appreciate that as not a member, you don't vote, but I do encourage others to come, and I would hope you would feel welcome to raise your questions as well. So I think therefore we just sustain an apology for Martin, either partially or fully. I'll move that to a seconder. You, Chris, appreciate that. I'll put the motion was in favour, please say aye. Well, against, it's carried. Any matters coming up you need to prepare your interests? No? Good. I would just like to record, Amy, I do need to give you an updated list of interests. They are changing subsequent to the elections, but none of them affect. Yeah. Fairness, any or chance, any examples or tributes we should not know of. I've got no notification. The public wanting to participate or any actions coming out of that. No urgent business. And there are no minutes to confirm. It's great, isn't it? Off to flying start. All matters arising. Well, it's a first meeting, so there are none there. Can I just check, Amy, with the agenda? Just confirm I've got everything in hand. We have our auditors with us. They will be with us for a couple of key meetings. You should have, I hope, their documents, which include the management report and an audit engagement letter. We will have Earl, I'm trying to say that the Treasury Management, the Treasury Policy aspects, and am I missing anybody else out from joining us, Amy? I think that's good. I've looked at the agenda. There's no, naturally, I don't think there's any need for us to change the agenda. We'll just rip into it and do it as we go through. So, Charlie, are you going to focus on this one, please?
Thank you very much, Chair. So I will take the policy and the report as read. Essentially, the background is to this that you should always be renewing and reviewing your fraud and corruption controls and policies. There have been some recent updates out from the Office of Auditor General, OAG, about their guidelines as to what should be in a fraud and policy, fraud and corruption policy. And they picked that up. You'll notice it's in our management report as well from last year that they recommended we add some things in there. So this is essentially an update. I have referred to the guidance from the OAG whilst writing the update for this policy. I believe there was interested in how we're going to be implementing it. So May, our lovely Principal Advisor of People and Culture, has coincidentally but rather serendipitously got a new training platform for our organisation coming online. So one of the first modules that we'll be putting out across the whole organisation is called Bribery, Corruption and Fraud New Zealand version. Now, although that platform is based in Australia, the company, they absolutely apply our standards and rules when they're writing the training modules for that. So everyone in the whole organisation, all employees, all managers, SLT, will go through that basic one. And then I'm planning on delivering a session to managers and SLT about what happens when someone reports something to them, and how we deal with that. I have also arranged with Richard, who is our information advisor, to have a form, and it will be cited on our intranet for the staff to access, but you absolutely cannot tell who they are. They do not have to sign in to get to that form, so they could send themselves the link and access it from outside. And it will ask them, do you want to be identified? If so, please put your name and contact details for reporting. But as we all know, there are whistleblowing protections and they are more than within their rights not to be identified. So that is also underway at the moment. Shouldn't take that long to do a form for that for us. So I'm actually really quite happy with this. This is the first time I've managed to get my teeth into this since I've taken on the CFO role, and quite pleased with that. So any questions?
Questions for Charlie, either comments on the policy or indeed think that we would have an update about how we're going to work with it. It's really, it's pretty, in one sense feels procedural, but to me it's really important. We actually going to not revisit, but fraud will come up again. We look at the audit engagement letter because of the absolute correctness of the Auditor General's position. We are responsible for prevention of fraud in the organisation. We don't rely on the auditors to catch the fraudster. If there happens to be one, we'll bet we might have a chat with them if indeed we found it. Bottom line is it's our responsibility. We don't have it as a strategic risk, and consequently it doesn't regularly come across our plate or table. But what it does mean ultimately is we need to be aware that these systems are in place, because later in the year you will be asking Fran to represent to the auditors that we are under control from a fraud perspective. So it is important. We just spend this 5 minutes now noting this, and also thank you for your update on how you plan to socialise this, to use a good consultant phrase, socialise this through the organisation. It's great. Seems like there's no more conversation. Is there one?
There's all a couple of questions by me. Thanks, Ashley. Thanks. I had a good read through it. I thought it was a good piece of paper, and from a policy perspective, just general application, how have you found it to use?
So we are applying this from when we adopt it. We have been working on our controls. We just haven't updated the policy recently. So controls have been put in around. When I first got here, we had the lovely old carbon paper purchase order system. It was very difficult to track, very difficult to see who was approving what and things like that. So we've implemented electronic purchase orders, and within that there are controls that basically follow the delegation policy. So that means that we're always naturally meeting the requirements of the delegation policy. The only people who approve purchase orders are the people who are supposed to. We have a process for when delegation is temporarily put to someone else, for changing that delegation over, and also changing it back once they're back from leave, for example. It can be quite an assumption that in a small organisation as such as ourselves, we see everyone every day. We'd notice if someone had their finger in the cookie jar. But actually, there are unique challenges to being in a small organisation because there's more direct involvement with the people at the higher end of the tier. And that opens you up for one person gaining a lot of pressure and a lot of control. I am confident that we don't have that issue in this organisation, but this policy update and the procedures along with it, particularly allowing a better process for anonymous reporting, I'm really pleased with. Yeah, formalises that. Yeah.
And just one final question. In terms of you did undertake an investigation, would you use an external investigator?
Yes, we probably would do. Yeah. Just again, because of the size of the organisation, there's too much knowledge of each other and intercourse. Yeah.
So that,
Thanks, Chair.
thank you. Any other questions? Perhaps just one final thought, because you did, sorry, you made a point on that, which is quite right. Segregation of duties, which is what our colleagues, the auditors, are always looking for. Effectively, you're saying it's not always possible. So we do have a level of concentration, which means we are, as a small organisation, slightly more exposed to the risk. I say that without any reflection on existing staff. It's just a matter of fact. I wonder if perhaps by 6 months' time, perhaps as part of the people capability report, might be just nice to know the stats on who has actually done fraud and corruption workshop. I'm sorry.
The training.
Yes,
that's
training.
Part of the reporting of the system.
Thank you. Well, I think it would be useful to just know that, because
and that
one of our best chance to defend it would be great.
One question. So this is sort of more pointing at sort of the officers and the elections. What if the fraud's perceived from the shareholders, the ratepayers? How would they address that with council?
So if they're seeing a fraud, there's a listing in there of who they would report it to. Generally, though, we would make that publicly available form on our website as well available, so they can put in a report of fraud as well. We just wanted to make sure that the one on the intranet couldn't identify staff if they didn't want to be.
Yes.
And it would be the same for the form on that internet, the web page. So people could choose to identify themselves or just make a report anonymously. Yeah.
Great.
Yeah.
Okay.
Okay, anything else? Brilliant. If we go to the resolution, we are receiving the report, and we're going to recommend to council they approve it. So it's got one more leg to go. So I'm doing it moving secondly. Thank you, Fran. Thank you, Rob. I'll put the motion. All those in favour, please say aye.
Aye.
It's carried. Thank you. Righty, let's do it. Let's move then on to the finance report, please, Joe.
Certainly.
Bring me back, Steph. I always, in a meeting, always try and jump one agenda paper ahead of myself. I did it 2 days ago, and I'll do it again today.
Yeah. As per the report and the appendix, council is in a slight is in an operating surplus, which is slightly behind on revenue, mostly due to reduced development contributions. I'm sure none of us around the table are incredibly shocked by that, given where the wastewater has been causing delays to people getting those resource consents. So we're hoping that will pick up. The economy will be the deciding factor on that one, I think. And that is definitely something we will have to keep a careful eye on in terms of the long-term plan, because obviously if we're not going to get the contributions in to fund growth in our infrastructure, and bearing in mind it will be road infrastructure by that time, the water entity will be the ones planning the water growth. That is something that we need to consider in our infrastructure strategy as to whether we are going to be A, needing to grow our infrastructure, and B, how we're going to fund that. And bear in mind that we take financial contributions, not development contributions. and financial contributions are not being proposed to be replaced by the development levies that are currently under submissions at government. So we would continue taking financial contributions on development, which is a smart thing for a small council to do. The administration involved in development levies and contributions can be quite onerous. Sorry, I went into a bit of a deep dive about contributions there, sorry. Yeah, but that's essentially the main reason our revenue is slightly behind. And we've made some savings in our expenditure. Borrowings have not yet changed for the year, although we are getting to that time of the year where we're going to start looking at what capital have we got left to spend this year and when we will need to borrow for that. The wonderful Earl is on with us to advise on that, and bearing in mind also we are very close to that 30 million where we have to start thinking about our hedging. Under 30 million is at the discretion of the CE. So any questions about the finance review?
Just ask Earl to hold off for a moment. Let's just deal with the numbers. Is there any other questions I should like? Yes, Rob.
Yeah, just on page 31, the Martinborough corporate office upgrade. Is that a typo, or you just explain 101,579% the budget remaining? What's the figure, please?
I think that's the carryover is missing from that formula by the looks of it. Yeah, so there is a typo in there. I can come back to the see on what that figure is. And bearing in mind this is a December report, so it's actually been quite a lot since then.
I was going to ask, that was the second question, given that you've now moved back into that office, you have an approximate idea as to where the final cost landed?
Yeah, absolutely. Unfortunately, due to the timing of this meeting being just before the quarter ends, we were basing our report on December. So I will circulate the quarter report for March month end once it's ready in about 4 or 5 weeks. Yeah.
I think Rob was asking you, got any sense that we've come in on time on budget?
I believe we have. Yeah.
Yeah. On budget.
Yeah.
Good. If we get that report, Chair, that would be useful. Thanks.
So if you could do that separate
Yeah,
thing.
absolutely.
And I appreciate that the timing's always can be a challenge for a committee that only meets 4 times a year. Frank.
Just it's not to do with these papers, except for the fact that they are December, which is quite old now. And we could do this outside the meeting, but I just want to signal that we might need to look at meeting schedule, because it's really pointless looking at things that are so old. And I don't know how long it takes you to get them ready after the end of the quarter, but we might want to just move around the meetings a little bit so we're a bit more fresh.
Mine and that we cite the RAC meeting just after.
I think so. Yeah, giving you whatever you need to get the.
Bearing in mind that they are bi-monthly, we will always have some months where we're catching up.
Yeah.
We need to have a conversation.
Yeah, we need to just talk about that outside meetings. Yeah.
Although if I could ask a couple of questions, actually, hopefully they are relevant. I thank you for taking on board your points, Fran. It sounds like, because my real question is what is the difference we forecast for other expenditure? I just want to understand is how much work has gone into the full year forecast at this stage of December?
So December is the first month that we do switch to forecasting.
Right.
So it can be a little bit of an early guess for some cost centre managers.
So that's really important context of what I was wanting to ask. I appreciate it's early, but I then want to ask that obviously our position is lower than we anticipated, and a lot the $1.8 million depreciation I think is understandable. We have some reduction in useful lives. That's meant we've had to take a bigger hit, and it's going to flow right through to year end. I get that.
Yeah.
Any sense of the $1.3 million variance on other expenses? We're going to look at the forecast here, which I appreciate is in your first month of work.
Yeah, absolutely. So some of that will be, in fact, a significant portion of that will be roading emergency works.
Right.
Which obviously gets
The
offset
revenue
by
side- the revenue side is
not
okay.
entirely,
Yeah,
but
yeah.
mostly offset, so
Yeah,
that's the main one.
okay, cool. We'll obviously see. Third thing, the other thing then, and again, this is perhaps, I like to look at high level. If I go to the bottom of the CapEx page, if I've got it right, at December, we're running at 21%. And if I picked up, again, I'm interested in the forecast. I think if I've got this correct, we are going to be close to 100%. 100% is a fairly challenging target to move up from. What's the plan to do that?
So part of that will be that Peter has been working on the procurement before Christmas
Yeah.
of the water projects. Those are rapidly now getting underway.
Yeah.
So that should be a nice
The
catch-up.
pre-planning's gone and so we're
Yeah.
comfortable to spend all that through.
And that's been a nice change to how it was under Wellington Water. We've got a lot more control on that. now.
Okay. Good. Well, that's good news. I mean, that's, I like to hear we actually have a plan that's working, so that's wonderful. Oh, great.
The same applies to roading.
Pardon?
The same applies in roading. Roading will, it's
Yeah.
seasonal, so that will pick up after Christmas.
I appreciate the February.
And then
or it's,
obviously
season.
I spend from the office.
Anybody that's trying to travel around the country now. That's good. Thank you for that. Are there any other questions before I invite us to move on to the Treasury Management report and get her all on board? Because actually this is probably the briefing of moment, given events overseas. Anything on the numbers? Colin?
Quick question in terms of rating arrears.
Yeah.
Firefighting with me. Is that about average? For arrears?
It hasn't peaked. It hasn't increased dramatically very recently, but it's crept up. It was around 3% prior to COVID.
Yep.
And no matter how much we think COVID was a long time ago, but essentially constraints on people's income have been existing since then and still continue to do so. So it has been creeping up. We do use our ability to speak to the mortgage companies and get arrears caught up on each year. So you generally find that the next quarterly one will have gone down in terms of the arrears we'd have caught up from the mortgage payments. It's not dramatically higher than, or it's not dramatically different to councils around the rest of the country, and councils are finding it that arrears are creeping up.
Obviously, you're getting more calls with people trying to work with council in terms of their arrears to try and set.
Absolutely, we work with people on their payment plans, repayment plans. We do have a postponement policy.
Yeah.
We, as I've mentioned before, have had no one actually go through with an application for it. I am keen to watch the development that local government funding agency are working on, and a scheme called Ratepayer Assistance Scheme, which is essentially not too different to the postponement scheme, but it takes the administration burden off of councils.
Yep.
And in a small community like this, it sounds so strange, but someone struggling might feel better speaking to someone anonymous elsewhere than someone from within their own community who they don't want to know that they are having financial troubles. It's usually the other way around. People prefer to speak to someone local, but when it comes to admitting that you're having trouble, we simply don't know the people that aren't speaking to us.
It's good.
Thanks, Joe.
Just one quick one. What was really obvious is that the direct debit really matched the more the direct debits were there, the
Yeah.
more the bills were paid.
Date.
Have you looked at doing some offers to get people onto that direct debit system to try and work them into it?
Very challenging with that sort of thing, because you don't want to be accused of incentivizing people who feel comfortable doing direct debit, as opposed to those who maybe don't trust it because of what the environment was when direct debit came out, with the power companies and things being a bit fast and loose with signing up and things. So, but what we are looking at is a platform that would work in with our website. We're in the very early stages of that, and it would make it easier for people to set up their own timing of direct debit, and also to be able to skip payments when they can't afford to, or maybe want to give themselves a bit of a break from paying just before Christmas or something like that. So very early days for that, but it also goes along with what we've heard from council as to being easy to deal with. And that, I think, is a good advantage. People would be able to make those payments, they'd be able to see their balances, and change their payment arrangement much more easily than they can at the moment.
Thank you. Thank you. Is there any comment you want to make about treasury position, or we would invite Errol to speak?
No, I mean, Earl has done a fantastically detailed report, and for those of you who haven't heard from Earl directly before, he has a wonderful way of turning all the economic data into things people understand. So I'll let Earl take that away.
Hey, welcome to the meeting, Errol. It's always good to have you here, buddy. Very interesting what you've got to say about the current environment, which I think is changing by the day, isn't it?
Yes, it is. You're not wrong. And thank you very much for that wonderful introduction, Charlie. I'll that $20 will arrive in your letterbox tomorrow.
Beautiful policy.
So, and that'll be the first test of the fraud policy. So shall I share my slides, or is that the easiest way to do it?
Yeah, good idea. Yeah, you go for it, Errol.
Okay, so can everybody see those? Are they on the screen?
Yes.
Hold on, I'll just do a slideshow. Oh no, that doesn't seem to, that's showing too much. I'll go back. Okay. Yeah, so can everybody see that? Are you seeing one slide or two? Okay, if I can't drag that over, so excuse me.
Next slide.
Oh, there it is.
Yeah, I'll go back. I'll go back to this. Okay, so here's our debt position at 28th February. We're all well aware of this. Our debt's under 30 million at the moment, and hedging was in CFO discretion. We continue to take advantage of the positive yield curve. So what that means is much lower short-term interest rates than long-term interest rates, and we've managed to take advantage of all those cash rate cuts we've had in over the last year or so. And as Charlie mentioned, that's within the CEO discretion, and the committee has noted this, but it doesn't need to be an approval from the committee because it's within the Treasury policy. So that hasn't changed much. Our weighted average cost of debt is 3.11% all up. Now we did a overview of council debt costs at 31 December, and that's just been finished. It's not quite finished yet, but we will send it out when we've done it to Charlie and the team. And you will be in the bottom 10% of council debt costs in the country. So, so the strategy that the executive team have been happy to pursue at this stage has certainly saved the council a lot of interest expense over the last year or so. So that's worked out pretty well. Okay, at the moment, at the end of February, there was just over $4 million in current accounts, working capital, et cetera, which we think is, that's manageable. We've certainly got down those cash balances over the last few years, so much more efficient use of cash. And Charlie's worked hard with that and getting the transactional banking stuff sorted out. So, certainly in the top quarter, in the top percentage of performance for councils that we see. Okay, so now on to the interesting stuff. So it was all going to be about, the Reserve Bank here has come out and they've left the cash rate where it is, but the governor's seems very balanced and a very sensible person, and all things had corrected. But I had to throw that out the window because we had on the 28th of February we had a bit of a change. But just to give you some background. Dr. Brennan's first monetary policy statement was a very good statement. They walked back the market from getting carried away about interest rate hikes. They acknowledged the New Zealand economy was recovering, but it was an early stage recovery. And at this stage, they only thought they would need to move the cash rate towards neutral over a year to 18 months. And that, that implied a cash rate a cash rate hike maybe late this year or early next year, the first one of the cycle, with the cash rate probably only going to 3.5%, something like that. Now, that's all out the window at the moment, because we're totally focused on what's going on in the Middle East. And what we've seen, which is not surprising really, is a big surge in oil prices. You know, we're all getting hit by that. You know, I mean, it's interesting. The oil price goes up overnight and there's 15 cents a litre on your car the next day, whereas when it drops, you don't seem to get that same reaction. But in New Zealand, we're really good. We're really good in having cartels, and the oil companies are no different. So the problem, the interesting thing, and so everybody's got worried about inflation. So markets are now pricing in higher interest rates. They're saying the cash rate's going to have to go up by 1% over the next year or so to 3.25 or even 3.50. Rah-de-rah-de-rah. Now, I'm not a cynic, but the banking sector likes higher interest rates because their profits are higher. So when there's a movement, you know, they tend to move rates higher quite quickly, and they tend to move them down a bit slower. So you know, markets react, and that's fair enough. But we think ours have gone a bit silly. But the key thing to think about is over the medium term, higher oil prices have traditionally shown us, and this history shows us that they're a drag on growth and consumer confidence, because they're a tax really. So if you've got to fill your car up and it costs $20 more, that's $20 less you have to spend on other things. So while it's inflationary for the cost of fuel, it impacts on a whole lot of other spending, and it actually has a real impact on growth in New Zealand, because, you know, the farming sector, for example, diesel's up, fertilizers up, all those, you know, these things flow through really quickly. And with the fragile recovery we're currently within, you know, we think that the impact of higher oil prices on inflation will probably be countered by the negative growth impact if this continues on for any great period of time. So we think markets are getting a bit ahead of themselves, financial markets, and pricing the 1% of hikes is kind of aggressive. And we continue to value the flexibility of having short-term debt. We think, you know, in times of crisis, the only real lever that central banks have is if growth starts to fall quite dramatically, the only lever they have is to cut interest rates, right? Or at worst, leave them where they are. So at this stage, we think there's no point. We don't need to anyway. There'd be no point in chasing the yield curve up here, and we're pretty comfortable with the position you're in, quite frankly, given the current environment. So here's what's happened. So markets. So the black line is where the Reserve Bank's expecting rates to go. So they're saying sort of like late next year the cash rate might be 2.75. After that statement, the market said, "Oh yeah, well we think you might go a bit earlier, but yeah, maybe 3%. We're happy with that." And in the last few days, the market's gone, "Oh, heck with that. We think it's going to be 3.50 or higher." So markets have aggressively priced in rate hikes by the central bank, and they've hiked, and they're talking hikes in August, September. We'd be very surprised if that happens. Very surprised. But markets have reacted quite aggressively to what's going on in the Middle East. They're looking at the inflation problem. At this stage, they're ignoring the growth problem. And if we look at what happens in the US, so the US 10-year bond's been trading between sort of 3.95 and 4.35 for the last sort of 12 months, really. And they were actually falling down towards the bottom of the range as markets were expecting the US economy slowing. So the the markets were expecting that, you know, the US economy is slowing. It certainly is. They're expecting the Federal Reserve to cut rates, and the long-term rate in the US was falling. Now it spiked up quite a bit because of, you know, the Middle East situation, but it's still within its range that we've seen over the last, you know, this hasn't been a dramatic blowout like the oil price, for example. So interest rate markets have been relatively relaxed within current ranges. But we look here, our 5-year swap rate, which is the base rate for, you know, all borrowings, you know, the swap rate's what determines what the LGFA's base rate is. That's jumped up from 3.4% close to 4%, and that's gone outside all the ranges, and it's higher than it's back where it was sort of in 25. So our markets are less liquid. The banks like to push these things up pretty quickly because, you know, in a way they go. But certainly there seems to be a bit of an overreaction here, you know. But that's having an immediate impact because that gives your banks the ability to put their fixed rate mortgage rates up and, you know, talk about, and stop lower rates. So certainly that seems a bit of an overreaction compared to what's happened in other domiciles. And there's the old oil price. So that's the last, that's over the last month. So you can see oil was sort of, and to be fair, this is the last 12 months, you know, it wasn't a surprise that something happened in Iran. I mean, you don't send most of your fleet to the Mediterranean and the Middle East and then not do anything, right? So it shouldn't be. I mean, you know, in New Zealand yesterday saying our hedging runs out in a few months. I'm going, well, it's been in this range for a year. Maybe you should have done a bit more hedging. But airlines, you know, a bit like oil companies, they just pass it on to the consumer. But they've got a bit of a lag, which is their problem. That's the issue they face. But if you look at this, you know, this is so she got to $120 on Monday. That was Monday morning. Biggest one-day move, I think, since the 70s. And then it came back quite quickly after talk about insurance in the Straits, US naval ships escorting boats, etc., and also opening up the strategic reserves around the world. It has gone up a little bit overnight on the back of a couple of cargo ships got hit. I think there was a bulk freighters, not oil, but more bulk freighters. So certainly it's a moving feast, but you can see the scale of the move in oil. You know, this is a big move, and that's the prices over the last year. So you think, oh well, you know, things happen, but it's a big deal even over 10 years. So this is a 10-year chart of the oil price, and back in so we saw it spike up with the start of the Ukraine war. Clearly there was an impact on Russia. You know, we had gas prices in Europe go through the roof when the Ukraine war started. Oil prices went up. But as you can see, it was a bit noisier and they stayed there a while. But this is a big move. You know, this is certainly a big move in prices. This is unusual. So you know, really, it's like we saw in the COVID madness and then Ukraine situation. So what's happening in our markets? The New Zealand dollar's trading within the range it's been in so far this year. Got sold down to the bottom. Now it's sort of drifting back toward the middle. So not much going on really over the last few months. So currency markets are sort of relatively quiet. It's all in energy markets. The New Zealand Aussie exchange rate. So if you're going to Australia for a holiday, grim news. It's getting worse by the day. If you rely on Australian tourists coming to visit you, this is the best in 15 years. So that's why every second accent's going to be Australian, and if they're not Australian, they're going to be Americans, because at 59 cents in their dollar. I mean, I live in Waiheke, and you know the Americans are going, wow, everything's so cheap. I'll have a case of that wine. It's only 50, you know, rah. And so certainly this is a positive for us because it's helping our tourism sector. Not so good for stuff we import from Australia, but in general terms, you know, it kind of looks a little bit overdone, but that's not happening really because of the war. The Kiwi Aussie was falling anyway, because basically that's driven by interest rates. Australia's putting up interest rates, ours are staying the same. So, you know, that's what's happening. Now getting back to interest rates. So the market's now saying there's going to be a hike in September, which is 10 months from the last cut, which was in November last year. The typical time between the last cut and a hike is 18 months, and for any cycle, up or down, it's around 15 months. So if the Reserve Bank does hike interest rates in September, that's really unusual, and maybe this Gulf War situation is a reason why there's going to be this unusual situation. But that's why leading into the Reserve Bank's meeting, you know, before this happened, we were kind of surprised, in fact, very surprised that the market was pricing in aggressive hikes, you know, because it just doesn't, it doesn't follow the game plan. Central banks don't do it. So now if this thing gets over quite quickly, you know, September still looks a bit aggressive, and it'll depend on the data. If the economy starts to slow, they've already telegraphed that they think that the recovery is kind of incipient, you know, and it's only just starting. So if we start to see economic data turn down, they will look through higher inflation from energy prices and focus more on the underlying economy, and they will be biased towards leaving rates where they are. And that's that's kind of where we think things are going to happen. Their view on the neutral cash rate is around 3-ish. So they're only talking about taking the cash rate up to neutral anyway. They don't see the economy strong enough to actually need to be slowed down by higher interest rates. They're just saying they might withdraw the current stimulus. So they're identifying, and I think Charlie pointed out earlier, households have been under pressure since COVID, and that pressure isn't coming off, right? So the Reserve Bank is not sitting there going, we think this economy is going to get out of control and we're going to have to tighten aggressively. You know, she seems a very sensible person, very balanced, and I suspect they're going to look very closely at the data and say, if the economy starts to tip down again, we don't want to be sort of, messing things up by preempting hikes. So that's, whereas Orr, who knows what he would have done. So, you know, that we've probably got a much more stable environment from our central bank. And why do we think interest rates here aren't going to go up aggressively? Well, there's the real house pricing index, right? So January 2012 was 100. So as you can see, the house prices index is back to where it was. What's that? Probably 2000 before COVID. So all those COVID increases in prices have gone, and but we still had quite a big increase from 2010 to 2018. So, you know, if you're a chartist looking at that graph, you'd say that doesn't really look like they're going to surge anytime soon. And if you look at this next one, this is house price inflation on an annual basis from RENZ. So they'd be loving to have this look better than it is, I suppose, because, you know, they like activity. But certainly that looks like flat house prices for quite a while. And that's very important for the New Zealand economy, because we tend to have, strong, people think that high export prices drive the economy, and we have an economic boom when milk prices are high and meat prices are high and all this kind of stuff, right? It's 25% of GDP. It ain't enough. The reason why we have economic booms is we have maybe good terms of trade, but at the same time, we've historically had surge in immigration and surge in house prices. And New Zealanders go, oh, my house is up, I'll go and borrow some money and spend it. Immigrants come in and they're buying TVs, buying cars, buying whatever. That supports the economy. So if we've got house prices that are stable at best, and in fact they're still soft, and we've got low levels of immigration, these high export prices cannot be expected to drive the economy to high levels of growth, 3-4%, something like that. And that's another reason why we think, even aside from the Middle East, is that we don't think our central bank is going to or needs to go in an aggressive hiking cycle. The New Zealand economy is fragile. We're still recovering from COVID. Households are still getting smashed by higher insurance charges, you know, higher rates, which, you know, and 90% of the rate increases in New Zealand are because of the imposts of central government on councils, but, you know, that's never acknowledged. And, you know, so, well, maybe not 90%, but a fair bit of it. So, and then we've got, you know, food price increases, we've got, you know, electricity increases, we've still got, you know, no competition really in insurance. So what happened in COVID, by focusing buying on supermarkets, so you could go to a supermarket and buy your groceries and wear a mask, right? But all the little shops had to close. They've never recovered. So it actually made the competition in the retail sector for food and other things worse, and we haven't recovered. So New Zealand's got all these levers which continue to put price pressures on households. So without high house prices and high immigration, I'm battling to see how people are going to go on a spending spree. So, you know, again, that means, you know, why would the Reserve Bank have to aggressively tighten? And we look at the banks. Well, what are the banks doing? The good old banks. The housing market's going sideways. We need some more business investment and agricultural investment, because that's the only way we can export our way out of the trouble. Oh, forget that, we'll just lend to housing. 80% of lending last year was housing loans. So bank lending grew by 26 billion in 25, up strongly from 15 billion in 24. Yahoo! 11 billion more of bank lending. Must have been going into dairy and, you know, agriculture and, you know, exports, you know, get the economy going. No, it all went into housing. So there doesn't seem to be anything in the short term that's going to increase exports as a percentage of GDP more than they were And the scary thing is exports are about 25% of GDP, right? They were that in 1960. In 1960, Ireland had, say, the same percentage of exports as GDP. It's about 80% now. So as an export nation at the bottom end of the world, we're kind of kidding ourselves. We haven't done a really good job. So with all this house lending going on, it's hard to see how businesses are going to suddenly turbocharge their production and turbocharge their growth and drive the economy as well. So again, does that mean interest rates are going to have to go up by the central bank? Probably not. And we look at what consumers are doing. Well, retail sales, you know, they were a bit higher last year, but actual retail sales on a per capita basis are still 10% below their mid-21 high. So people are spending less because they've got less disposable income. And we're not seeing signs anytime soon of that turning around. Now, higher petrol prices means that retail sale numbers the numbers won't go up. It'll just mean the skew will go to be more spent on fuel and less on everything else, right? That's what we were talking about before about that tax situation. So household budgets are still squeezed, you know, it hasn't turned around. And unfortunately, in the private sector and in the public sector, wage growth has certainly fallen back. The boom in sort of 20 out of 23, you know, you had situations where private companies trying to hire accountants, for example, were being squeezed out by central government. You know, central government was leading pay increases. Now that's gone. So now you're seeing, so wage increases are relatively low. Another reason why households haven't got a lot of disposable income. You know, they're not going to get, people aren't going to get compensated for higher petrol prices by a higher wage because companies, quite frankly, can't afford to pay it. So again, does that mean higher interest rates from the Reserve Bank? Probably not. And then you look at this is really, God, I'm being depressed today. If you look at this GDP per capita, so this is a pretty, I mean, if I was a politician going into the election this year, I'd be going, maybe I should come out with some policies that are going to fix the structural issue New Zealand's had for a long time. Maybe we should say to people, let's be honest, guys, we need to have a blank sheet of paper and see what's going on in this country, because real income in New Zealand, real GDP is actually going backwards. So when obviously it fell during COVID because, you know, everything happened. But what we've been doing is we've been bringing in more people, so we all get a little bit poorer, and productivity growth. New Zealand tends to throw people at a job rather than buy a fancy machine or do it better. So productivity, it's bad in Australia as well. The only reason why Australia's productivity numbers are better than us is because they've got mining. So you can replace 10 people with a truck, you know, whatever. But so our record's bad, but so is theirs. But productivity, the lack of productivity growth is a structural issue. So again, the Reserve Bank's not going to sit there and go, oh, the New Zealand economy's on fire. Best we put those interest rates up aggressively to slow it down, guys. So it's good news if you're a borrower, but it's not such good news for the structure of the economy. But that's an argument for people at a much higher pay grade than me. But it's a pretty damning graph, I reckon. Got to have some good news. Exports are really a bright spot. So what you see here is the black line is the price in New Zealand dollar terms, and the red line is the price in US dollar terms. Now, we had a bit of a fall in dairy prices. Basically what happened was in December last year, Fonterra panicked. They thought that the supply of milk globally was going to be much higher than it was. They took their payout down. They actually took some money back from farmers. Oops. Dairy prices have gone back to their levels again, and Fonterra's had to sort of reassess. So dairy prices have surged. That's the big move in US dollar prices, and with the currency only up from 55 cents to 59 cents, the gap between US prices and New Zealand prices is still really attractive. So the export sector is doing really well. And you know, tourism is doing really well because we're cheap, but you know, we're a great place to come. But being a great place to come and having wonderful scenery and wonderful people is good. A cheap exchange rate certainly turbocharges demand. You know, a lot of people go, if a Kiwi dollar was a dollar against the US, people might say New Zealand's wonderful, but I'm going to Mexico. It's 50 cents in the dollar. They're going, we're going to New Zealand. We don't care about the flight, right? So certainly the export sectors are positive, and that's doing really well. Unfortunately, it's not big enough to actually offset some of these other conditions, but that is really good news. And as I showed, dairy prices going up. Global inflation, well, that's going to change, but it was starting to get back into control. Now, what's happening in the US? Just quickly, non-farm payrolls fell quite dramatically last month, and the unemployment rate's up. So is the Federal Reserve going to react by hiking interest rates because of higher oil prices? No. Is it going to slow down their rate cuts? Maybe. But the US economy is weakening before this. So the global outlook is neutral at best. Again, why would the Reserve Bank have to aggressively hike interest rates if the global outlook is flat at best? And our biggest trading partner, China, are we going to get a boom from China? No, we're not. This is a graph of house prices in China. So as you can see, since 2022, there's been 2 months when prices have gone up. So most people are expecting this slump to continue for another 2 or 3 years. There's still a huge oversupply in housing in China. People are underwater on their investments. That's why young people aren't having families. So the birth rate's dropping because they can't afford to, basically. We've got an aging population in China anyway, so actually demand for new housing is falling. So the shrinking population in China means demand for new housing is 75% below. It's 27. Imagine if that happened in New Zealand, 75% below the peak in 2017. This shows what happens in a market where you have a housing bubble and you don't have ongoing demand. Oops. So, but what this means for us is that the Chinese will continue to buy our commodities, but they're not buying Louis Vuitton bags. They're not buying BMWs. They're not buying Mercedes. They're buying EVs. So it's okay for us, but certainly from a global growth point of view, China's actually easing back its growth levels. Again, another reason why our central bank's not going to have to, act aggressively in the face of this. So our view is we've got a lot of debt short term. We've got the water split coming up in the not too distant future. So our advice is to continue to borrow for 2.65% for 3 months rather than pay 5% for 5 years or 10 years. We don't see the sense of that. And we think that if we can keep that interest expense down near 3% for the ratepayers for the next little while, we're doing the right thing for the community and we're doing the right thing for the council. And we know there's more risk in that than having certainty, but we think the cost of certainty is certainly not worth paying at this stage, despite the volatility going on, and maybe because of the volatility going on. So we think you're in a really good space when it comes to risk management, when it comes to interest expense, and when it comes to your focus going forward. So the thing that's going to hit you guys is your ratepayers are probably going to be still under a bit of pressure, because that recovery that we were seeing late last year, early this year, was starting to look quite useful, could get undermined because of this. So that's probably the impact we're going to see is, more people having income problems and things like that. But certainly from a borrowing and treasury point of view, you're in great shape, we think.
Brilliant, thank you, Earl. And I'm deeply appreciative you took that time because we only hear one part of the story, don't we, in meetings about oil prices, which you've given us a floor of how you see that impacting us. So 2 things, folk, questions for Earl about his general summation of it, and most importantly, the Treasury position that we are in. And the critical point that Earl's making, that he's comfortable in his recommendation to us, we stay short term.
Yep.
The price of certainty, which is traditional place of local government and is reflected by the slide, which we are under, we are saying, well, Earl is advising us the price of that certainty is too much. I just want to reflect on that for a couple of moments because Earl's given us a good chance, right?
Chair, it'd be interesting. I think, if you look at government policy, with households under pressure, rates capping must be even more attractive now in terms of a fiscal means to keep prices down. So just a question for Earl in that regard. And then I'm interested more so in your comments about debt. And then just to clarify on the actual debt situation. So we had a maturity in February of this year of 17 million. Was that rolled over? We've also got 2 coming up in April of this year, where are they placed? Because that would bring our debt even further down if that was not rolled over.
So we don't have in our treasury policy to repay debt. We roll it as we need.
So you keep it. So then can I ask because the original terms would have shifted on these.
Yes. So as I was hinted at, we're utilising shorter term.
So at the 2.5 or 2.7.
Yes, it'll get us about that point. And so the ones in February were rolled into a maturing in November, and we'll probably look at the same maturity for the April ones. We will tick up slightly in terms of our overall debt level, and we will breach the 30 million in our policy fairly soon. But as was mentioned, all the prudent advice would be to keep that under short term. But we obviously need to liaise with you, council, on that now once it goes beyond the CE's delegation. So yeah, that's why this is a perfectly timed presentation, so that you can understand why shorter term is saving our ratepayers some.
So just to put in perspective, so that November maturity was rolled at 2.97%. A 5-year loan, for example, would have been at about 4.4. And we've got a maturity, and we've got two maturities in April. The average rate is around 3.5. So we will finance them for a similar term under you know, around 3-ish maybe. So that means that your weighted average debt cost will go down from 3.11 to closer to 3. So now we're comfortable with that. And as Charlie said, you know, the water situation means that some of your debt is going to disappear anyway. So why would we be hedging aggressively, you know, for 35 years when it might drop to 15, or who knows what it's going to be. So we're thinking let's take advantage now, and, you know, not just blindly follow a policy which might only be live for a short period of time.
Yeah, thanks for that, Earl. I was just about to mention the water transfer.
Yeah, that was
Actually, the way that the program is leaning in terms of, I don't know whether a decision definitively has been made on this yet, but the way we're leaning on it is that the entity will give cash to the councils as our debt matures. So actually, it's an advantage to us to plan our debt so that it matures soon after transition. We don't want to be holding that debt, even though they would take the cost of the. Yeah.
So you're saying a short-term borrowing, for instance, once that matures, the entity will continue to service that debt until such time as it matures. So the transfer of that debt will occur at the maturity of the borrowing for that particular.
So it looks like the option is that when our debt matures, the entity would borrow to pay us back all that, so that we've got the cash for that debt.
So what's our projected forecast for debt? I guess July 2027.
It would have changed dramatically since the projections that I can get you. That will be part of the annual plan work that you'll see over the next few weeks. As you remember, we borrowed a lot less in the last couple of years because the capital program was not as aggressive as we would have liked it to be as forecast. So, yeah.
So we've been working with a number of councils, and we've got a mandate with about I think 5 of the new water entities to advise them on their treasury going forward. And we've been working with the LGF very closely around transition arrangements. And as Charlie pointed out, one of the scenarios is they give you the money when the debt matures, but they pay the interest expense on the percentage that's theirs from day one. So let's say you had 20 million bucks worth of debt and 10 million was water. You mightn't get the 20 million for 6 months when that loan matures, but you'll get reimbursed half the interest expense on the existing loans. So your council's made good. And so you know, so it's and as Charlie pointed out, it makes a lot of sense to have these things as short as possible because you want the money back in your pocket as quick as you can.
Earl, can I just get a bit of clarity around that? Because the reality is that we're not going to receive the income from our water services delivery, this council, and yet it's still expected to service some debt without full reimbursement, or what?
No.
Full reimbursement. No, I was just saying if half your debt was transferred, What I meant is if you had $20 million worth of debt and 10 million was water, you would get reimbursed half of that 20 million. If all your debt was water, you'd get the whole lot.
Yeah.
So it has to be fair, and no party has to be better or worse off. You know, give or take a few dollars here or there. The other methodology, which we tend to be using in a lot of the other entities, is that the debt is just novated over to the new entity, and you lose it on day one. So there's various options, but at the end of the day, council will be made good and won't bear any costs on that debt from the transfer date that's relating to water.
Thank you.
Okay, thank you for that. Colin, any other questions for Earl? Sweet, Earl, look, thank you for that. That is really valuable. And as I think you've indicated, or you might have said, Charlie, useful to have this knowledge now as we track forward. Well, I just must confess, I had one question. Thinking negatively, we have a policy, and I'm quite comfortable with it. What would be the first signs that we'd have to change the current Treasury approach? In other words, what might be the signals that say all of a sudden debt's going up? I mean, I think that's the interest rate, but what underlying indicators could there be in the economy that might say we have to change that?
I think if we, I think given the size of your debt and the potential decrease because of water, the dollar value of your interest expense is going to be declining, not increasing. So if you look at history, the floating rate average is less than the fixed rate, right? So let's say we would have to be expecting the cash rate to be going to 5 or 6% before we'd start to get really worried. If it's going to even 4, we'd go, well, the numbers still imply what you're doing sensible. So we closely monitor the differential between the two, and we monitor the implied future floating rates and say, look, the curve is saying the floating rate's going to be here, here, or here. Does that make sense? No, it doesn't. We're comfortable with our scenario. So at the moment, the yield curve is implying the cash rate's going to be 5%, very soon, and 6% after that. We don't see that as a scenario, given those fundamental views of the New Zealand economy we put forward. But that's what we monitor, and that will be the first. If that starts to change, that will be our first signal. Look, we need to start to think about this. Something's going wrong here. But we're watching it all the time, obviously.
Right. Thank you for that. I think we're. Questions?
One quick one. So we looked at America and China as being the powerhouses of the world at the moment. Is there any country that's sort of sneaking under the radar and building power at the moment?
There's always been talks of the BRICS and India and all this kind of stuff, but the reality is that the three powerhouses globally are the US. Well, 4 really: US, China, Japan, and the EU, right? The EU is kind of interesting, but certainly the US and China are well ahead of everybody else. The US, for all its faults, is still the most progressive economy in the world. Innovation is they do the most innovation. They've got the most liquid financial markets. They do lots of stuff. They've got a very mobile workforce. People will move around. They react quite quickly. Europe doesn't happen. Japan's got an aging population, and China's problem is that China's got this massive aging population, it's going to be like Japan. They hit a cliff. So yeah, in the short term, it's hard to see another big economy coming through and going, we're the new champion. India's been talked about for 20 years, but they've got some structural issues as well. But certainly India is going to be more important, and that free trade agreement with India is probably, for all there's a few little fables I need to work out probably, but it's probably going to be useful. But the trouble is the Indians are very protective around milk and meat and stuff like that, right? So unfortunately, there's our big products. The Chinese are huge purchasers of our protein, right? They're always going to be very important to us.
Thank you. Thank you, Chris. Right, I think we just go to the resolution then, please, which is that we see the report. We should say firstly thanks to you, Charlie. Also thanks to you, Earl, for your support and behind the scenes. And we do need to just note those tax risks, but we were in a second for those motion calls. Thank you, Rob. Thank you, Fran. I'll put it to those in favour. Please say aye. Aye. Against is carried. Thank you, Earl. We'll release you to your
Okay, a pleasure,
afternoon.
everybody. It's a pleasure as always, and I was hoping to be down there live this time, but things change. But I'll certainly get to Martinborough soon because I hear a bottle of beautiful Martinborough Pinot with calling my name most days. So I need to get down there and get it in the flesh. Thank you very much. Have a great day, everybody. Bye.
Right, thank you for that. I hope that was useful. Thank you, Joey, for Earl's aid. It's an entertaining speaker, but there's a very fundamental message there that's important to us about why the graph is the graph on page 34 of our agendas, the sitting beneath our treasury or our planned treasury prudential limits. We move now to the audit matters, which is useful. We've got two key documents to consider, which is the engagement matter of the audit plan, plus we've had the report to manage. Charlie, best way to take it?
I think the best way to take it is that you have read what is here, and I guess you have time to look over the report from last year. So maybe I will talk to that specifically. Yeah. Because you've had a chance to read the other documents.
Just in terms of order, I would like to deal with the report close out last year.
Yeah, absolutely.
Just get that away. Can you give us that brief? So that's this additional piece that's been floating around. Absolutely. And then we'll deal with the plan because that's okay.
So the closeout to the 2024-25 year, which is obviously from before your triennium began for some of you, involves having a report from Audit New Zealand with recommendations to management about some improvements that can be made. And they give us priorities as to essentially whether things are essential that need to be fixed, should be an improvement, or would just be a better thing to look at. For those of you that were here last year, you'll remember that we were not able to report on one mandatory DIA roading measure. So I was very not surprised to see that as a high priority on our report. And we're working with the roading team, with the roading contractor to make sure that we can report that for this year. I wouldn't be at all surprised if that was brought up on our audit opinion if we somehow were not to report that. It was last year, but we are working very hard to get that measure reported. The other two medium matters were our fraud policy not having been updated. Well, thank you. Hopefully once council sign that off, we'll be able to have that one drop off of our report. The other one was an operational matter last year. We changed our payroll system, and because we're a small council, we have a tendency to do things quite informally and by in person, not papers and reports and formal documentation. So when we did our checks that the data was fully migrated over and that we did parallel payrolls in both systems for a couple of times around both for staff and for elected members, we just spoke about it in the office and said, do they match? Are they matching up? Are they giving us the same result? Audit have rightly said that formal documentation that had taken place would have been a good thing for us. So just a little reminder there that small council thinking can perhaps be a bit more formalised, just to tick a few more boxes and give people assurance that things happen correctly. The low one is something that we have been working on for years, is that fully depreciated assets, so assets that have zero book value, are still in use on our fixed asset register. And does that mean that we are assigning too conservative and useful lives to our asset classes, or more, as I suspect, are we sweating our assets and really thinking about it when we replace things? And I believe that is what we are doing. I don't think our useful lives that we have in our policies and that we use for our depreciation calculations are different to what they would be if we were actually replacing our assets on a schedule appropriate. I mean, I've heard from our IT team as part of our office move, that we've got screens that he just doesn't understand how they're still working, but until they stop working, he's just going to keep going with them. So that sort of thing. So yeah, which is prudent and based on what I think the community would want from us. But certainly if you're a business, you just get to the end of your useful life and just replace your asset regardless, because you're a business, you on charge all of that to your customers. So yeah, but I was very pleased with those recommendations. Obviously not pleased with the one about the roading measure, and we'll definitely be putting all of our efforts into that. But the other three were sensible, and I have drafted our responses in a letter, and that will be signed off and sent back. Speaking of audit, this is probably a time they've been hanging on for an hour for us. So it's probably a time to introduce our auditors to you. So we have Sefton Bully and Letitia Chetta online. Now Sefton is, for all intents and purposes, our audit boss equivalent. So he represents Audit New Zealand, Officer of Auditor General for us specifically. And then from a day-to-day coordination and operational point of view, Letitia is more the contact that we speak to every week, sort of thing. So they have put together the audit plan that has been tabled at the last for us for 25-26. We had the opportunity to make some changes to that before this document has gone through to you. And I wonder if, through you, Chair, might I get Sefton just to introduce himself a little bit more and perhaps explain his role in terms of governance, because Arlen and perhaps Fran and Colin, we're all fairly new as governors to local government audits. So, yeah.
Thank you for that. And Sefton and Letitia, welcome to the meeting. So Sefton, yes, please, introductory comments, anything you want to say about the management report, and then please give us a sense of your plan for the year.
Thank you, Mr. Chair, and thanks, Charlie, for those comments. Just very quickly on the management letter, outlining those points. We're very pleased, firstly, as to the responsiveness by management and council to the points raised. I think it's also reflective just that there were just 4 points that we raised in the management report for last year as to how tight and well run the organisation or the council has been run. So just to come up with 4 after a comprehensive audit of the nature that Audit New Zealand conducts is testament to the responsibilities or how seriously the council has been run. And the responses that we've seen so far are very appropriate and very responsive too. I've already heard earlier the fraud policy being adopted, so thank you very much. Just very quickly on this year's audit, we've got the same team. I think that's the main thing that we wanted to trying to put a bit of consistency there. We did manage last year to complete the audit in accordance with the timeline set out. So we hope and we are planning to make sure that we do that again this year. The areas of audit focus are included. The main area would be the valuation of assets, infrastructural assets, that we will put quite a bit of effort in there, audit focus in there. We propose to do that hopefully in July if it's ready then, but we'll talk with Charlie and make sure that the timing for that review hopefully can be conducted as soon as it's ready. We don't expect the issues that had risen last year to arise, but Charlie pointed out very appropriately that the mandate measure for roading that was an issue last year needs to be addressed. We did manage to get away with it not, sorry, that's probably inappropriately phrased. Council was able to avoid a qualification in that regard. And so what we want to ensure is that it is not something that appears again as an issue. I think that's all I have at the moment. Unless there's anything else, I'd be happy to take any questions.
Great, thank you. So the only other thing I just want to note is that the way the Auditor General works with his audit service providers, he works in 3-year lots, and so we have an engagement letter in our pack, which is from the Auditor General through Sefton saying, I'm engaging Sefton to be our auditor for the next 3 years. The letter is actually really important, and I think I've made this point before because it goes back. The focus I always do reading it in terms of the particularly the schedule at the back is actually our responsibility. But actually we can't and we're not able to offload our responsibilities to Sefton. Okay, he certainly can be helpful in us meeting our obligations, but we're accountable. So that's really what's important there. And in the background also, there has been an understanding and an agreement over a fee for the job as well. So that's good. So we've got the management report, particularly we've spoken to. We've got the plan going forward spoken to. We've got questions for either Sefton or indeed Charter. Bill, Rob.
Chair, just a question for, if I may, for Charlie first. In terms of, you made a reference to our assets. Do you frame sort of asset replacement in terms of putting things like a car should be replaced or considered to be replaced every 5 or 7 years or things like that? So you confirm that you do have that in terms of asset management processes?
Yeah, absolutely. Our policies, which is a very dry section of our annual report, annual plan that I suspect I'm possibly, alongside Leticia, the only ones that read it every year, but it does include a range for each asset class as to how the useful lives we expect from that asset class. We look at that every year, but it would be fair to say that, as I mentioned earlier, that we have been going slightly beyond those asset replacement schedules. And I believe vehicles in particular is something that Janice wants to address. I don't know if you've seen some of our older utes, but they certainly could do with a little bit of a.
I think he's still on the usable vehicle which was bought for the mayor back in 2016.
Yes.
Talking about sweating your assets.
I suppose the second thing, and it's correctly identified out in the audit plan, and it's in reference to local water done well, about the council having to decide on appropriate accounting policies to be followed. I suppose the clarification for me here is it's probably not, is it an individual council decision, or given this is a joint entity, we would have to have the same policies, I'm presuming, going forward. So that's the first thing. The second thing, but it's not referenced here, but probably would need to be taken into account, is actually we're setting up a whole interim arrangement to run through till June 2017. So it's that interim arrangement which would need to be audited as opposed to how we're going to go into the new entity. That is that to be taken into account?
Yes, so to answer the first question, we are one of 4 councils. We are working together as a program to guide how the entity sets up its policies post-transition. I did have some of the wording in this plan adjusted because it slightly overstepped the scope perhaps originally of what audit we're going to be looking at. They're not auditing the new entity, but obviously they need assurance that there's going to be a tidy and planned handover, and we're not just getting to the 30th of June running and throwing everything over into a new fence. So that absolutely will be something that we will give assurance to Sefton over the coming 18 months, not quite that now. in terms of the transitional arrangements, obviously there is still some contract negotiation underway at the moment, so it would be not appropriate for me to mention that at the moment. But once those are more formalised, we will absolutely be assuring Audit New Zealand that all of our legislative requirements and our reporting requirements will be able to continue under the transitional arrangement for the 26-7 year. So perhaps not strictly what you would call within the scope of a 25-6 audit, but certainly something that we'll be giving them assurance of over the coming time. So that, yeah.
What form does that transitional entity take? Is it virtual or is it real? Is there a company or?
No,
Which transition arrangement?
Sorry, I thought Rob.
Which with the Wellington Water ceases on the 30th of June this year.
Yeah.
So we've got another contract coming in to replace that, which we will operate for a year, and then it will transition to the Wairarapa
Oh,
Tower.
sorry, I understood Rob's question. I thought there was
not
some
the
form of
transition.
established unit or something that was.
It's about that year.
Yeah, no, I understand.
early days we did entertain standing up the CCO for one council a year early, but that the option that we've gone with is of a contractor. Yeah.
Okay, bring on. Thank you. Thanks for that, Rob. Appreciate that. Any other comments, questions about this? Charlie, my key thing is, again, I look at the timelines.
Oh, yeah.
And, my question is, have we got a plan to meet these deadlines, these times?
We do.
Good.
As always, it would be very tight.
Yeah.
As always, we all have other things going on when we're a small organisation. I mean, Wellington City Council have a whole team just to do their annual report and their audit and things like that. We don't have that. So it is very much a case of working very closely with Sefton and Letitia and the team, getting a totally brutally honest communication going. So if something is looking at slipping, we need to tell each other that very early on. I will note that on the proposal letter, last year's actual hours were 250 hours more than they had planned, which makes their 2026 plan look a little bit naive from a cold perspective. However, what I would qualify that is that we changed our audit director partway through the year. We changed a class of assets from one to another. So we reclassified or corrected the classification of our investment properties to our PP&E, and that took a lot of time to give the reasoning around that for. We had a revaluation of our buildings. So there's been some hours, 28 hours added for the revaluation of the infrastructure assets. So I'm pleased to see that. I'm pleased to see that it wasn't just the same number that they budgeted for last year. But we are in the second year of working together, and I believe that makes things more efficient, just naturally anyway. You're not having to spend that time learning how each other works. And after the transition to Sefton and Letitia last year, we found it a lot better, the relationship there.
I can remember.
I cannot stress that enough. Yeah.
My primary concern is our.
Yes.
Our project. I'm not overly worried about Sefton.
Um,
I'm concerned is the wrong word. This is always the stage where I look at this and think draft financials on the 7th of September, that's great news. But I know there's a lot of hard work that goes into that, and what are the risks around that?
There are always risks, especially with a small team. If one person gets ill or something like that, there's always risks. But equally, we do have backups and redundancy within that team. We don't just have single point failure there. To give a little bit of background to councillors who maybe don't know the team personally, I have one of the most stable teams in South Wairarapa. Most of my team have been there at the same length of time as I have, which is 6 years. Some have been there 9 years just now. So It's not like we're having to teach new people or onboard new people every time. And I guess the most realistic way I can give you some assurance that I'm confident of this timeline is the fact that I'm going on holiday in July. I wouldn't be doing that if I didn't think we could.
Think of going on holiday in July.
And yeah, and so my parents will be definitely having a problem. And yeah, I'm confident that my team will be doing. The July is the time that they are busily ferreting away with the little accounting things that accountants love to do, moving numbers around from one place to another and talking about debits and credits. So when I get back from holiday, I'm going to be turning those debits and credits into your annual report. And I am 100% confident that we'll be delivering on the timeline.
Thank you for that. I would, before you go, which I forget our next week.
Got another one before then, yeah.
It would be useful just to understand that all plans are still,
Mhm.
I'm going to say tickety-boo,
Mhm.
that actually there's a chance that we'll get there, which is good. Otherwise, that's fine. It's going to be an October sign off. It's totally within the statutory deadline. Makes
Mhm.
it sense. So I'm comfortable. We look at that. Any other final questions for either Sefton, Letitia, or Charlie? There being none, we look at the resolution, please, which is that we receive Sefton's plan, we endorse the engagement letter, and we ask Fran to sign off on behalf of council.
And you the other ones.
Sorry. Tell me, Amy, what have I missed? Sorry. Yeah, here we go. I missed something here. What am I after? Oh, okay, there's a few more, it's additional. So just to retract, so I'll go backwards. Approve the plan or receive the plan, approve the engagement being signed by Fran. We note the recommendation of the report. We approve me and Charlie signing off the response to New Zealand.
Happy to move that.
Thank you, Colin. Do I have a seconder? Thank you, Chris. Motion, those in favour, please say aye. Aye. Against, it's carried. Thank you. Appreciate that. Sefton and Letitia, thank you, and we look forward to another good engagement. And I appreciate your hard yards, guys. Thank you
Very much.
Thank you.
Righty, I think we're up to the risk management update. Stefan, is that you that's going to lead us through this, please?
Yeah, thank you. Thank you, Chair. Look, I'll take the paper as read. Risk is a subject of regular review from SLT. We look through this fortnightly and then review it prior to these meetings. I think in the report it's mentioned that we're due a workshop. That's where we will take a stronger look at this with elected members, consider things like confirming our approach and appetite. Also, obviously we see risk as an important component of strategy. So with elected members, we put risk alongside the strategic objectives of the organisation and understand it in that context. I don't propose to go through the paper, but I'm of course open to questions and comments from the table. Thank you.
Great, that's wonderful. Thanks, Stefan. I appreciate it. It's always difficult. You know, I do sense that probably we'll all be very quick once we get to the workshop. And I think if I got that right, it's the 23rd of April, which I'll be encouraging all councillors to be at, not just the committee. So I hope that's an evident need there. And in fact, I'd love to have you guys there as well, Stefan. So really just a chance for a reasonably quick look at this. In fact, want to raise any questions about our current risk profile? Yes, Rob, go for it.
Yeah. And it'll be useful to take this up when we do have our on the 15th. There are a number of policy elements actually I noted into this risk plan, which probably were not across as a council as yet. An example of that was the reference to advancing planning measures, including coastal retreat into our district plan, as something that needs actual reference to the council for a proper discussion, because it's quite a sensitive and significant issue. So if we could have a think about that, and there are a couple of other things as well that I've noted throughout the plan, which are actually policy issues which haven't actually come for the council as such.
Would you be able to flick those through to me?
Yeah, sure.
Thank you for that.
Thanks, Rob. Ms. Brent?
I'm interested in internal risk, and particularly I'll talk with Jan about this key person risk. We're so tiny. We've got, like, what happens if Charlie doesn't come back from holiday? That's probably not so, well, we've got Jan, who knows that area.
Good job.
But there are areas, the infrastructure area, where we are highly dependent on a couple of people, or one in each area, and quite honestly, if anything happened to them, we're in real trouble. And I'm not sure how that is taken into account here. I think it's a high risk for us
It is.
right now, actually, with all of the work we're doing on infrastructure.
Yes, I agree. Sorry. Oh,
Where is that? Where is it?
SLT has a separate list of operational risks that we consider alongside people issues, and that's one of them. How to mitigate against single point failure in the business is something that we talk about regularly. You'll appreciate it's very difficult because single point failure exists right across.
But there are some areas like Animal Farm that are more equal than others in this respect, actually. Some are more important for us right now.
And I think that's really what I was saying earlier. We'd really welcome a conversation about risk in relation to strategic advising.
Yeah. I mean, it's more, it's all very well through you, Chair, SLT talking about it, but for me as the mayor, the actual, that key person risk is really big at the moment. That's a strategic risk for us because we need to deliver the policy and the strategy. And I think it's not just like it's an SLT issue. We're concerned about it.
I think, and I think that's, yeah, I don't know if everything on the 23rd of April, Frank, but I think your point is well made, because you'll notice, I'm looking at the table on page 76.
Yeah.
You'll see that there are two organisational risks.
For that.
Which are all seems being equal, dealt with by management, but which, because of their importance, have raised the key to our level.
And they should be too, those ones.
Whether it would be useful, Jan, at that time to have a good discussion with you. Bearing in mind, we do also have some good information in the later P&C report, people and capability report, which is helping.
Yeah.
If you're going to say, Jan.
Yeah, I just think it should be reflected here.
Get sense, but I'm probably of the mind to agree with what I say. But to agree with your friend, I actually think it needs the level of validation in terms of status and this as a strategic risk, but we can perhaps discuss that later. Jan, I did perhaps steal your point. There's a report here later, but is there any comment you did want to make?
No, I was just going to say we've got that in two places in the risk statements on the people report around those risks.
Yeah, it should be reflected in here.
Yes, that's what I'm saying. I agree. That sense, totally agree. Anything else folk would like to raise? Just a couple of questions from me. I don't know why, Stefan, what goes through a chair's mind when they review risk? I looked at two things. One was climate change and one was asset failure.
Yeah.
And I just want to ask that you guys have gone through obviously a significant weather event, broadly, let's call that intensity and what have you, that's occurring under climate. And I noticed it's a high risk. And I think I also, if I got it correct on page 88, noted that some of our initiatives that were presumably planned to reduce our risk are on hold. So I'm just interested in a high level answer. Given we're at, I think high must be outside our risk. Is it okay that we've got these three major projects which would presumably reduce that risk on hold?
Yeah, thank you, Chair. I think the main impediment to us advancing the mitigation is that previously climate change was dealt with on a regional level as part of a shared service with our colleagues in the Wairarapa. And recently there's been unfortunately decisions made to retreat from a shared services approach. that really took out the capability that we had to work,
People,
yeah, to work on it. So,
Yeah.
and of course, something like climate change demands a regional approach. And so we are, we're a little stuck. And this really relates to SR9 as well, in terms of that deliberate sort of cross-council leadership piece, which is missing at the moment. We are currently, we have a proposal on the table in council to try and ensure that up and address that gap in climate change for us as the council, but it's no replacement for a region-wide approach. This is what we really need. That's the main impediment, I think. Janice, do you want to add any? You think?
So that remains red high risk. Again, I think just represents the value of us being able to sit down with a slightly more open situation in the workshop to discuss further. Okay, that's really helpful.
And then critical, I think you mentioned critical asset failure.
Yeah.
I mean, that critical asset failure risk is really, you know, that's pure affordability pressure, really. I mean, it's you don't have debt constraint means you don't have enough capital investment at the level that you need. That in turn drives more OPEX costs for maintenance and repair, and you just get into that cycle, and we end up playing whack-a-mole across our asset classes.
We've got critical asset now, Chair, in our sort of.
So it's an issue.
And that's actually wasn't just the debt issue, it was previous decisions not to invest.
Yeah.
So that was what the issue was.
Comes back to Colin's point about sweating.
Yeah, exactly. Yeah.
It probably pales in its significance to total asset value. What is the number of assets we have at zero value in our books? Because the assumption was we're sweating them. They must be the primary assets. Is it just cars and trucks, or is it other assets which essentially their life has come to an end but we still use?
Chair, there are some playground assets that were previously at zero net book value that are still in there, but in the long-term plan, there is quite a good program of replacement right in playground areas.
Yeah. So I must confess, I'm thinking more about the big.
Well, you'll probably live with that for a while.
In an old person out grandkids, I want to see safe playgrounds, but I'm thinking more about our fundamental infrastructure, which critical asset failure sits in. Thank you, Chris.
Just a quick comment on climate change. Like just looking at what's happening with the climate at the moment, like we've been talking about climate change for the last 10, 15 years, but as of about 3 to 4 months ago, our current climate is actually off piece to what has been ever seen before. And La Nina and El Nino are actually not working anymore. And we're about to see some things we've never seen before.
Right.
And it's going to happen quickly.
Yeah.
And I think, sorry, Chair, just if I could just close that off, I think it's not as if we're not doing anything to address this, to mitigate this risk. We are working with our elected members on what the right levels of investment are within the constraints we've got. We are improving our asset management understanding. Governance certainly improved, and we've got we are trying to improve our monitoring and our controls around early warning, so that we know that things are going to go wrong before they go wrong. But just to return to what I was saying before, when I first started at council, the pressure was on drinking water, and we spent millions to address that. We're currently feeling the pinch and wastewater, and probably bridges are coming at us next. So that's what I mean by whack-a-mole. We sort of, as a small council with the affordability constraints we've got, means we just move through the classes as we go.
Looking at critical mitigation around that will be indeed the work the governments will do with that asset management strategy, and dare I say the financial strategy will determine a lot about what you can achieve. Okay. Well, thank you for that. I could go on all the other ones as well, but I don't proposed that we haven't mentioned government reform, which probably most of
help
us would focus most on. But I thought it was, for my lead today, I was interested, given the situation, some of the circumstances we've faced here in the last few months. So that's fine. Other questions folk would like to raise at this moment? That's the case. Thank you, Stefan. I think useful to record, because of the 76 is a quick summary. We're in a slightly uncomfortable position with a lot of red.
Yeah.
And what I'm sensing on, I mean, let's face it, we are critical risk asset failure that is in our hands to some extent, but we've got to go through an LTP process. A lot of the other ones at the moment, it is difficult for us to be other than a risk receiver. We can't, not a lot we can do other than, as you say, to monitor carefully. So that'll be a really interesting discussion on the 23rd as to where it goes, including, Fran, whether we add or subtract other risks to this, to the schedule. We'll be open to that. Okay, can we move to the resolution, please? Thank you for this, Stefan, that we received the management report and we note the information included in the updates. I'll move that. Do I have a seconder, please? Thank you, Fran. I'll put the motion. All those in favour, please say aye. Aye. Those against? Carried. Brilliant. Have we got time, people? Do we need a break? Push on through?
Yeah.
Well, okay.
3:30, you will need to have a resolution to carry on.
Thank you.
Right.
We'll take a break. Okay, so we go to 3:30.
Or even just 10 minutes. Yeah.
You got 2 minutes now.
Oh, I do want to push through on this one. Sorry.
No, I'm quite relaxed. I'm taking the sounding.
10 minutes.
Yeah,
Yeah.
okay. That's okay. That's the bad that.
Oh, got the yawn.